Hi everybody, and welcome back to this first lecture on IFRS 17, and in particular how it compares with the way in which we've done Solvency II type calculations in the past. So in the first video we compared IFRS 17 to Solvency II and talked about how the IFRS 17 balance sheet differs from the Solvency II balance sheet at a high level. And then in the last video we covered the best estimate liability, again how it differs from its Solvency II equivalent, and then this new thing called the risk adjustment. So let's put in a kind of video break line there. So in this video I think I'm probably going to get through all three of these things. We're going to talk about the contractual service margin, the third and last kind of new component of the balance sheet. Talk about what happens in future years, because initially I'm going to talk about this at time zero, and then do a little summary for you. So let's kick off with this contractual service margin, CSM. Okay, so the CSM measures the amount of profit locked up in a group of contracts. At time zero, it is, so I'll call this initial CSM, and I'm going to do max, and then big curly bracket, expected present value of premiums minus expected present value of claims minus expected present value of expenses minus the bit you might not expect, the risk adjustment. So the maximum of all this stuff, comma, 0. Put in a big curly bracket here, and let's label this kind of formula before the comma as star. Also, let's make a note. This formula includes time zero cash flows. So all of your new business strain is all contained in this formula. Try and underline this. Okay. So that's my initial CSM. So if the risk adjustment goes up, so you calculate or you think that there's more risk associated with a particular group of contracts, then that implies the initial CSM goes down. I'll just add in a quick note, open bracket, we will cover the situation star less than 0 later. So when we're talking about this, let's just assume that when we do this star calculation, it comes out with a result that's greater than 0. Okay, so that's what we do initially to work out the CSM that goes into our IFRS 17 balance sheet. In future years, each year the BEL and RA are updated for any new assumptions. So our actuarial assumptions can change, so the BEL could change and the RA could change. Also, the initial CSM, or the CSM after the first year, but say we're 1 year later, the initial CSM is adjusted for unwinding of the discount rate. Now we'll talk about what this means a little bit more in a future lecture, but that's what it's called. Changes in experience so maybe you expected, I don't know, £100,000 in claims, but you got £150,000 in claims. That would be a change in experience, adjust the CSM. And changes in actuarial assumptions. Okay, fine. If there was no change in experience and actuarial assumptions didn't change, then the only change would be this unwinding of the discount rate thing. As I say, we'll go into all of this a little bit later. However, in addition, and this is really the most important point to kind of take away from this section, in addition, part of the CSM is extracted and paid out as profit. The idea is that this extraction is spread out over, let's do that again, over the lifetime of a group of contracts. Let's just add in brackets, as the CSM reduces, the RA reduces too. Okay, so sorry, 1 second. So this formula here kind of captures the amount of profit that is locked up in the contracts, less, however, less an amount of money that's put aside to kind of cover risk. So so all the profit that you think is in the contracts is somehow inside of here to begin with. And then what IFRS 17 does is it releases that profit gradually over time. Now that's very different to how we usually think about things as actuaries, where there's a big new business strain, so that's a big loss at time zero, and then kind of smaller amounts of profit in the future. And that really is the kind of key difference here. This CSM concept and how it is distributed over time is important. Okay, let's just kind of summarize all of this. So that was contractual service margin, and in future years. So let's do a summary. So all the above means the IFRS 17 balance sheet will differ from, I'll just put the old kind of regulations in here, IFRS 4. In the past, and be different to the Solvency II balance sheet. So I should have said that this whole CSM concept is new for our accounts. New compared to past accounts, and definitely new or different to Solvency II. Solvency II doesn't think about profit or construct a profit and loss account. Also, profit emerges gradually over time by reducing the CSM and reducing the RA. Now, I've not talked about any numbers yet in terms of how it's done, but this is the kind of most important thing to just take away from today. The CSM thing is set up, the RA is set up, they're both reduced gradually rather than in kind of, rather than the way in which you would expect profit to emerge under Solvency II. Instead, the profit emerges gradually by reducing the CSM gradually. Typically, not always, the risk adjustment reduces in the same kind of way. Okay, so in the next lecture, I will do some numbers. We'll go through some of this kind of CSM type stuff with actual figures so you can see a little bit in a little bit more detail how it works, and then hopefully it should start to make a bit more sense for you. Okay, good stuff. I'll see you next time.